Did you know that one of the main reasons so many traders fail is because they overcomplicate everything? Technical analysis does not have to be complicated. At its core, it's actually very simple. In today's video, I'm going to break it down. The foundations of technical analysis, the same techniques that have worked for over 100 years and still work today. So if you want to simplify your trading and focus on what really matters, make sure you hit that like and subscribe, and let's dive into the video. 8 years now, and I'm a 100% technical trader, which means that I'm focusing on technical analysis and I do not really incorporate any fundamental analysis into my trade ideas. So I've been working here with the Fivers for about a year now as a content creator, and I'm also the host with Victor, my co-host, for the live trading room that we got going on here. I'm also a funded trader here with the Fivers, just like Victor. And yeah, that's us. Now, what is technical analysis? So technical analysis is basically a method used by traders and investors. And the way I look at investors is more, they're using technical analysis on the higher time frames. They're more of a position trader. So I would say investors and traders are using technical analysis to basically try to predict future price movement. Okay, that's the underlying use case for technical analysis. And it does involve studying price charts like the one we're looking at right now, find different types of patterns in price that can help you predict future price movement. And that's basically it. Now, you can compare this to, imagine how weather forecasters, they're predicting tomorrow's weather by analyzing current patterns such as the cloud formations and perhaps air currents. So while they cannot predict tomorrow's weather with absolute certainty, they can make a reliable forecast by observing today's patterns and trends. And just like weather forecasters is doing that, technical analysts, they used past and present price movements to make predictions about the future market behavior. And just like weather forecasters, they rely on specific tools to predict tomorrow's weather. A technical analyst will use a wide range of different tools to anticipate market movements. So the technical analyst toolbox is very extensive, with hundreds, if not thousands, of different techniques and tools available. And in today's presentation, I want to focus on these tools, but not all of the tools. I want to focus on the foundational tools of technical analysis. Because a technical analyst, we need a solid grasp of basic market principles like trend behavior before we move on to more advanced techniques. So imagine that a carpenter must first master the essentials like how to use a hammer and a screwdriver. And the same goes for a technical analyst. We need to learn how to master, in my opinion, market structure. We need to understand how is the market moving according to market structure. But before we take a look at the actual market structure analysis and what that is, we're going to be looking at, or I'm just going to be giving you a brief overview of the history of TIA, because this is an interesting one. And while I plan for that, I want to ask you a question in the comments, okay? What do you think is the first instance of technical analysis in recorded history? When do you think the first example happened? So we got one saying in the 50s, 1800s, 1980 years ago in Japan, 1800s. We got a lot of people talking about Japan, 1986 by some Japanese guy. Okay, so this is interesting. If you maybe thought about a specific market, a specific Japanese person in the Japanese rice market, if you thought about that, you would be absolutely wrong because it happened way earlier. So let me take you back to England. Imagine England in the 1600s. It's dark, it's cold, it's raining all the time. In England, back in the days, you had lottery tickets. You had a lottery that were funding public projects. And you had people trying to predict future lottery prices by plotting the prices on a piece of paper on a graph with the highs and the lows and the opening and all of that stuff. And with that, people were actually um, they were trying to anticipate the future price of lottery tickets and lottery prices. So that's actually the very first time in history that we saw technical analysis being used in the 1600s in England. But then in the 1700s and the 1800s in the Japanese rice market, you had a samurai. Like, we don't know if he's a samurai, but I would like to believe that he was, because this would make it so much interesting and more fun. We had someone in the Japanese rice market inventing the candlestick pattern. Okay. And that is the way that we're interpreting price action today. So imagine that someone invented this method in the 17th and 1800s in Japanese rice markets, something that we're using hundreds of years later in pretty much exactly the same way. That's quite fascinating. But then, of course, you had in the 1900s, you had a man called Charles Dow. Now, you might hear that name and think, Dow, I heard that somewhere else. And that's because the Dow Jones Industrial Index is named after Charles Dow and based on his teachings. So Charles Dow, he developed, well, actually, he didn't develop the Dow theory, but he wrote a series of editorial letters to a newspaper that he co-founded called the Wall Street Journal. And then other people took those letters and combined his teaching into what is now today known as the Dow theory. And I'm not going to go into great detail on the Dow theory here, but basically, in the Dow theory, you will hear things like, today we talk about smart money concept. Okay, we talk about smart money concepts like accumulation and distribution, where smart money gets in at accumulation, smart money accumulation and distribution. In Dow Jones times, he talked about the knowledgeable investors, which today we would call institutional traders. And in the Dow theory, you have accumulation, ranges, and trends that leads into distribution ranges. We're going to talk about this a little bit more when we look at market structure. But it's important to understand that Charles Dow, is regarded by many as the father of modern technical analysis. If you want to go deep into the actual foundations of TA, I would recommend studying the Dow theory and Charles Dow, or you can tune into the live trading room next week where I'm going to do a detailed analysis of this. And it's interesting to, when I asked about the history, that literally no one knew about that in England. So it's pretty interesting. But that's where technical analysis first came from and laid the groundwork. Now, the Japanese candlestick, I'm not going to talk about in detail because Abe already did that in his beautiful presentation on Forex trading. What I want to focus on is market structure and horizontal level. Let's go over to this one right here. That's the candlestick. That's the one we're not going to be looking at. We're going to be looking at this one right here. Now, most of you watching this webinar probably knows about this already. This is the foundational way that the markets move. The markets, they tend to trend. Almost all markets out there, they tend to trend. For some reason, they just tend to trend. And technical analysis came from the idea that we have to identify the trends and ask ourselves, how can we participate in the trend for as long as possible while managing our risk accordingly? And this is much easier said than done. Technical analysis is rather simple, but making money using technical analysis is one of the most difficult things there is to try to master. But the key to mastering this is understanding the very foundation of technical analysis. Let me see. I'm going to bring up the right window here. So, like I said, one of the most foundational ways of viewing the markets is looking at market structure. And of course, this is originally called market structure analysis. Now, essentially, markets, as I said, they tend to trend, moving in one consistent direction. And this, as you can see here, is categorized as an uptrend with higher highs and higher lows, or a range where you have equal lows or equal highs right here. Now, going back to the Dow theory, imagine that you have a range here as well. This would be called a accumulation range. Now, imagine if this is the higher time frames and prices coming down here into this support range area, that would be the accumulation phase that that Charles Dow talked about, where the knowledgeable investor, smart money, or the institutional traders are coming into the market. When price exits this range, it tends to start a trend. And this is then the public participation phase where the public gets interested because now it's trending and it looks like it's going to continue up. So the public is jumping on the train. Up here, you form a new range after the public participation phase, which creates a distribution range. Imagine that you're sitting in your taxi, and let me know in comment if you've ever been in this situation. You're sitting in a taxi, and your taxi driver pulls up phone. You see trading view, 1,000 times leverage, Bitcoin long. If that happens, you know that you're most likely in the distribution phase. This is where everyone's just piling in, everyone's just running to enter the market. And this is usually where smart money, knowledgeable investors, the institutional traders, they know that the liquidity is there to sell the positions that they've bought down here. And the cycle repeats itself over and over and over again on all time frames. If you understand this, you're going to have a much easier time understanding the creation and the development of trends. So that's the underlying foundation of trend analysis. Now, again, it's much more difficult than it sounds, because not only do you want to identify the trend, you want to make money trading this trend as well. Now, I wanted to make sure that this was just not a random, boring presentation. I want to make sure that we're actually looking at live examples and actually demonstrate what we're talking about here. I think that's quite important. So what I want to do is I want to go to the Euro NCD chart right here, and I want to mark out market structure, show you what I'm doing, how I'm doing it, what I'm thinking when doing it. This is also going to be part of your assignment. Now, I'm not going to go into great detail on what the assignment is or how to do the assignment, because that is all in the video on the assignment page. But what I would like to recommend is, when you're taking a screenshot, press the camera up here on TradingView. Press that camera and you have different options. You can download the image and then upload the image as part of the presentation. So let's try to figure out what type of structures are we seeing on Euro NCD. And by the way, Euro NCD it's just too beautiful, okay? It's just this chart right here. When we're talking about market structure identification, this is the one you want to look at. And this is also why I wanted you to use Euro NCD in the assignment, because if you're going to be learning how to identify levels and market structure, this is the perfect Forex pair to do that. We want to be first looking at the overall trend. And let me know, what do you think we are seeing here? Is this one trend, or do we have different types of market structure? Let me know in the comments if you're seeing anything obvious here on this chart right here. What do you think about that? And when you comment on that, I'm going to show you what I'm looking at. And I'm going to begin ranging. We have a lot of people saying range, which I assume that you're talking about this area right here, and you would be absolutely right. This is a range. Now, what's interesting about this range right here, I would say, is you have distribution ranges, you have accumulation ranges, you have uptrends, downtrends, ranges, you have every single type of market structure within this range. So yes, it is a range, but it's also everything else. And you might be thinking, what is this guy talking about? I'm talking about the fractal nature of price action. Within every move on the higher time frames, there's a whole universe of different trends, and I'm going to explain that. Let's begin by first identifying the highs and the lows. And the thing with technical analysis is it's subjective in nature, okay? If I add, let's say, a horizontal level, or if I show you what I interpret as an uptrend or a downtrend, you might not agree with me, and you don't have to agree with me. Technical analysis is more an art than a science. An uptrend to me might not be an uptrend to you. A short setup might not be a short setup for you. You might be going long where I have my stop loss. So let's begin. We have an overall low here. Now, some might say, well, wait a minute, you have multiple lows here. You have one low here, you have one low here, and one here. But when looking at the overall primary trend, we're not looking at the very small, lows, the very every detail of the low. We're looking at the overall structure. This is a high time frame swing point. From this area, you clearly created a low. And same thing goes for this level. You could be looking at this as a high and a higher high with a low and the lower high. But I choose to view this as one high area, one low area, high, low, and high. So the thing I'm looking at here is the overall primary trend is the moves between these points, which creates a low, high, lower high, no, higher low, and then we continue like this. I've been saying higher lows and lower highs and all of that for so many years now that it's very easy for me to confuse the words here. But please let me know in the comments if I say something that might be a little bit confusing. But this is the overall primary trend. Now, you're pretty much, I'm sure that you're with me here. Now, let me know, of course, in the comments if there's anything here that's not clear, and I will help you out. Now, the beautiful thing about the fractal nature of price action is that a move on the daily, okay, a move on the daily will be a lot of times a trend on the lower time frames. We're going to take a closer look at this move right here. We're going to go into the 4-hour. Okay, let's go back. Let's use the replay tool here. Back to that one. So we're going to be beginning from this level, go to the 4-hour, and we're going to be looking at this move. Now, a move that was just straight up on the daily is obviously a trend on the 4-hour. Now, again, we can be very, very detailed with the highs and the lows. We could be doing something like this, or we could just, again, look at a overall view just to get a feeling for the actual trend. And in that case, I would just doing this. Maybe I would just do one move here, which might not make a lot of sense to some of you, but just to demonstrate that we do have a trend here within this move. And then we do enter a range here. Looking at the 4-hour, we see that Euro NCD had a uptrend here, entered a range here, moved into a downtrend, entered another range here, moved into an uptrend, starting to form a range here. Now, what do you think will happen here? Now, of course, you know what's going to happen because that's the daily right here. But what's interesting here is that the swing highs and the swing lows on the daily is quite clearly some sort of sideways price action or ranges on the 4-hour, which, again, we talk about the idea of accumulation and distribution. So we talk about the accumulation and distribution. And remember, what happens up here? Well, you're creating that range, and then you're breaking the range to the downside to create a downtrend. So you see that from a set of higher highs and higher lows, you create equal highs, equal lows, and then you start to form a downtrend right here. So that one downtrend on the daily, or that one move on the daily, is a trend on the 4-hour. Now let's take a look at this move once again, but this time we want to zoom in on the even lower time frames. Let's see if we go to the 15-minute. Now on the 15-minute, we're going to have way different structure, okay? We can see that, again, the overall trend is to the upside, but what we're seeing here is between these moves, we have many different moves. So one down move on, let's say, the 4 hour is a whole different universe of trends and ranges. Here, for example, you can see, let's say that might be a range with perhaps a fake out, which leads into a possible downtrend here, and then a big move to the upside, which leads to a downtrend. And as you can see here, that the highs and the lows are never going to be perfect in the live market. And that's why I wanted to do this live demonstration of marking out the market structure, because it's never going to be perfect in the live markets. The one Forex pair that I've found is the best when doing this is, again, Euro NCD. I think that gives a very, very clear market structure on the daily and on the 4 hour timeframes. Now, let me go back here. And I would like to know from the viewers in the comment section, how many of you feel like you have a good grasp of market structure analysis and how to analyze market structure? And if there's someone out there watching this and listening, and you feel like you have trouble understanding market structure, then this is the perfect live session for you. Because if you do ask me a question in the comments, I'll bring that up and I'll break it down with the sole purpose of helping you understand, so that tomorrow or when you're doing the assignment, you will know exactly how to mark out structure.
Yeah, we have a lot of people in the comments identifying with that question, saying yes, me. So the question you ask resonates with a lot of people in the audience.
You've seen now that analyzing market structure is quite simple. You want to look at the highs and the lows. But what you also want to do is you want to look at two things. You want to look at the possible break of structure and the change in behavior. Okay, so you have uptrends, you have downtrends, but you also have the behavior of those trends. Okay, so we can look at, for example, if you have, go back to this one. Now, this is obviously an uptrend. Okay, so I want to ask you guys, where do you think you have a sign of change of behavior of the trend? So what I'm going to do is I'm going to give you a few options right here. I'm going to give you one. That's going to be one. This is going to be two, and this is going to be three. So when price reach this level, with these levels right here, where do you think the price or the change in behavior starts? Is it when price reaches this high, number one? Is it when price gets above that high as number two? Or is it when you have equal lows, number three? Okay, we can agree that everyone says three, right, Victor?
Yes.
Everyone is
almost everyone.
Three. Okay. This is very important, guys. So I want to make something very clear here. There's a difference between a change of behavior and the break of structure. Okay, Caroline says two. Can you bring that up? Someone says two, and that was Caroline. I'm gonna bring that up if it's possible. But we got a lot of people writing right now. Yeah, that's it. Caroline says two. Now, okay, I want to explain why she's right. Ask yourself, what's the behavior of this trend? Because we're anticipating that the behavior of the trend is going to continue. That's the whole idea with trend analysis and technical analysis. We'll look at the markets, we'll look at trends and patterns. When we have find a trend, we can expect that trend will continue. When you hit that low, you bounce. Well, you hit that high, you bounce, 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 failure to bounce. Okay, you create a high, but you fail to hold that level. That is going to be your first sign of a change in behavior. Look at what happens if I add a trend line here. I add that trend line, price gets below the trend line here. Price has already changed here. This is no longer the same trend. This is no longer the same behavior as previously. This is now showing us a possible change of behavior of the trend. And at number three, when the behavior has already changed, you're getting a possible range forming, because now you have one low, two lows. Price goes up, creates equal highs. Now you have two equal lows, two equal highs. You have a range, okay? And I would also argue that a range is a break of the trending structure. When you're no longer trending, you're in a range or a downtrend, right? So, well, you're in a range if you're no longer trending, of course. So you enter that range, and that is a break of structure. And then you will, of course, have a range will break structure as well. And the range can break its behavior as well. And when the range is breaking the structure, that's most of the time when a downtrend is starting. It's important to remember that an uptrend can break structure into a downtrend or a range, and an uptrend can break structure into a downtrend without first forming a range like this. Okay, so it doesn't have to be a range, even though if you zoom in on lower time frames, you will most likely find a range, even if it's only on the 1 minute. But the break of structure that is most profitable for a trend trading trader is the break of structure from a range and utilizing these distribution and accumulation areas. Now, how do we actually trade these break of structures, right? Because the change of behavior tells us that there's something going on. We might have a break of structure. So when there's a change in behavior, that's when you're going to pay attention, because the break of structure always comes after the change in behaviors. It's important to understand the difference between these two. Two of the most common technical tools that traders use in the market is horizontal levels and trend lines. And I strongly believe that technical analysis is best viewed as a risk management tools, like I said earlier. And once a trend is identified, a technical analysis will determine the entry points and, of course, how to manage your risk accordingly. And this is where the technical analyst toolbox comes into play. And like I said, one of the most effective way of doing this is horizontal levels, and a lot of people like trend lines as well. But I stick with horizontal support and resistance, or also called supply and demand area. And I want to closer look at these levels and how I apply them in trading. Now, Abe, in his session, he already explained horizontal levels. So I'm not really going to go into deep into how I apply horizontal levels. I will do so in future sessions, but what I want to talk about though is just some simple rules when adding horizontal levels. Now, for most of you, I'd say 99% of you, unless you have a you want to be using a top-down analysis when you're adding your horizontal levels, unless you have a profitable trading strategy where you're only looking at one time frame. But if you do that, then you already know how to add the levels. So you want to be using a top-down analysis, and basically what that means is you want to start at the higher time frames, add your levels, go into the lower time frames, and refine your levels based on what you're seeing. And you want to think of the horizontal levels in terms of horizontal lines like this right here. I'm sorry, you want to add a line, but you want to think of the lines as areas, not exact zones. It's not going to be one price. A horizontal level is an area. So there's always going to be a buffer zone around your horizontal level. When looking at strong levels, you want to consider the number of touches. The more level is respective of price action, the stronger it's likely to be. And you also want to check the how long has the level been in play? You see many touches and it goes back maybe all the way to 2015. That's a strong level. And of course, you want to look at the strength of the reactions to the level. Let's see if we can find a live example of that. I think there's going to be plenty here on Euro NCD. Let me add a level here, horizontal level, and let me explain why it's a strong horizontal level. Let's just put something on here. Let's just do a big level perhaps here. Okay, so what you see here is quite a lot of violent and strong reactions to this level, and I want to bring your attention to this one right here. Obviously, you see price coming into a resistance area, and that the head of that resistance initiated a very, very strong move to the downside. That's a very good level. This level as well goes back way, way, way back in time. It's been respected pretty much since the dawn of time. and you see many levels, this level being hit a lot of times. You also want to look at, has the level been resistance and support? Has it been both resistance and both support? That's also something you want to take into consideration when looking for horizontal levels. And you want to put, when you're going to trade this, okay, so there's a difference between just analyzing the market and actually trading the market. When you're going to trade these levels, you want to put more emphasis on the most recent price action. I want you to look at the right side of the chart. You're doing your analysis on the left side of the chart, but I want you to put your focus on the right side of the chart when you're going to be trading these levels. Because what happened in 2018 or 2013 back here is not as important and as what's happening right at this current price. Because even though the markets are moving in the same direction, they're moving for different reasons. It's important to always put the most recent price action in focus. And of course, you can also, if you want to reduce the noise here when adding horizontal levels, you can go to the line chart, which is this one right here. Now, what the line chart does, it basically connects the opening of every candle, but you will get much less information. You will not get the information of the daily fluctuations. You will not get the information of the high of the day and the low of the day. So for me, I think it's best to use the candlestick chart when adding horizontal levels. But if you're starting out and you want to see the extreme highs and lows, then line chart might be good for you. But you're getting more information from a candlestick chart, which I think is better. So again, it's not really complicated. When you get the hang of it, it's not really that complicated. What is complicated is again making money from these ideas. And yeah, I mean, a trade idea based on technical analysis won't really do much if you're not able to turn it into profits. So you can't just put a horizontal level on the chart and say, oh, that's resistance. Price is probably going to respect that level. And sure, most of the time you'd be right. But the real question is, how do you actually trade that level? And that is, of course, like I've said hundreds of times, probably it's much easier said than done. But I want to be looking at two core principles for actually trading these levels. Now, I believe trading these levels and trend lines, and they didn't really show you how to add trend lines, but it's the exact same principles, okay? I believe when adding a trend line, you need 2 touches. A lot of people say you need 3 touches to confirm a trend line. No, you need 2 touches. 2 touches creates a trend line, and you can trade those trend lines just the same way as you trade horizontal levels. I find that for me, the best thing is, if you're going to be using trend lines, at least also add horizontal levels to see if there's any confluence between a break and retest or a breakout of a trend line. That's also a breakout of a horizontal level. But again, that's completely personal to me. You might find that something completely different works best for you. And throughout this week, we are going to talk more about specific trading system and trading system development. So you'll get to know how to develop your own trading styles. Breakouts and break and retest. Okay, so two of the core principles of trading this is using either breakout or a break and retest. You will see that most systems out there, probably 95% of all the trading systems out there, are based on some variations of using horizontal levels and applying either breakouts or break and retest concept. We can look at an example of possibly a breakout. So let's look at that one, perhaps. See if we can find a good example. Put a level on here. I'm actually going to go to the weekly here, but you have to understand that even on a weekly chart, price action will move and look very similar to the lower time frames. But here we have a horizontal level, and let's just create a zone. So we're going to incorporate more price action around this horizontal level. So we're going to doing something like that. That's our horizontal level. Okay. This is the breakout. Now, how do you trade the breakout? Well, there's many different ways of trading the breakout. You have many different orders that you can use. Again, Abe explained that very beautifully in his session from this morning. You could, for example, put orders right above the level, like stop limit buy orders or whatever, and then they're going to get filled when price breaks above the level. Then you might want to be putting a stop loss below the candle or whatever, and then TP perhaps at the next resistance area or something like that. But that's the general idea of a breakout. Now, if you look at an uptrend, this is an uptrend, right? And what if the what if the characteristics of this trend looks like this? That's the breakout, and it looks like that. And you see that some of the times the levels are not getting tested. Okay, this is the behavior of the trend. The levels are not getting tested. And if you see that this pattern is repeating itself in the market, then using a breakout strategy obviously makes quite a lot of sense, because the break and retest strategy is based on the break and then having that level being retested. But if the retest never happens, and I know if you're trading Bitcoin, you know that Bitcoin loves to just leave everyone behind. Gold, I believe for the last 6 months, when gold had a major breakout, it never retested breakout level. I think the first time that it retested breakout level on the daily was actually perhaps last week. I think that was on Thursday or Friday last week. So a breakout strategy on the daily on gold would have worked absolutely beautifully, and a break and retest strategy would not even have given you a entry and a position. So the danger of breakout trading is obviously buying a fake out. Okay, what is a fake out? Fake out is simply, could be two things. It could be the fact that I think a picture perfect real fake out is when you have one candle closing above the level and the next candle closing below the level. So for me, a fake out and a false breakout is actually two different things. And I'm going to show you why. Because if you read a book on technical analysis, it's going to say that a fake out is a failed breakout. But there's a difference. And I will show you the difference. A fake out is a move where the candle is closing below. This is obviously where it's like, I'm doing a breakout and then right back below, trapping all the breakout traders and a fake out, right? And then continues lower. But a false breakout is when you get confirmation. Okay, you get confirmation because there's different types of confirmations you can use to determine if a breakout is a real breakout or not. And I would like to say there's two types of confirmations. Either there's a single candle close confirmation, or there's a second candle close confirmation. A second candle close confirmation is a great way of determining if a breakout is a fake out or not. The problem with that is if you have a strong momentum move to the upside, you're going to miss it if you wait for too much confirmation. But let's look at the daily. Now, look at this. We have one candle closing above the level. If you're looking for a single candle close above the level as confirmation of a breakout, this is a confirmed breakout. If you're waiting for an open and close, two candles closing above the level, then this is a confirmed breakout. This is a breakout. This is not a fake out. This, however, is a false breakout because you're seeing the trend is actually moving in the direction that we wanted. Let's just say that we have a high and a low here just to make it better visually. And it is moving in the same direction. It is retesting that level. It is breaking out and it's retesting. But what's happening here is it's actually ending the trend. Okay. And we start the downtrend. And this to me is a false breakout. You can even look at it at the 4 hour. Go into the 4 hour. This is a beautiful breakout. And this could also be perhaps traded as a break and retest. But when the break and retest fails at resistance, it's most likely because of a false breakout. Now, you don't have to use these concepts, fake out and false breakout, but I think it's a good idea to differentiate between the two, because when you're developing your system later throughout the week, you want to have different ways of viewing this. You want to make sure that there's a difference between, I'm going to talk about now with break and retest, with immediate retest and rounded retests as well. So that's the overall breakout idea. Now, understand that with breakout trading, it's good to look at the multiple timeframes. So even if you're trading on the lower timeframes, let's assume that you're looking at the 15-minute, you're looking at a resistance area. On the 15-minute, it's a confirmed breakout with one candle confirmation. But then you want to make sure that you also have a second candle confirmation on perhaps the 5-minute, or you want to have multiple candles closing above on the 5-minute, maybe 2 5-minute candles closing above, but on the 15-minute, you only need one. So you have multiple time frame analysis confirming the breakout. Now, let's take a quick look at the break and retest, because I know Victor is waiting to talk about order blocks daily here. So that's a breakout. Now, what is a break and retest? Now, we go back to the uptrend. And again, in this webinar, I talk about mostly buying uptrends, and for selling downtrends, it's the exact same thing, but everything in reverse. I think most of you can assume that you now understand if this is a breakout, then this is the retest. Okay, so that's the break and retest. Let me see if we can find an example of this in the live markets. Webinar, this is always going to be a bit longer because I do want to make sure that we find live examples, not just give you the theoretical stuff. We want to make sure that we give you the actual practical stuff as well. And this is what the whole bootcamp week is designed to do with the assignments as well. I think I see one. So we have, and this is actually a beautiful example right here because we do have a downtrend. And then if we assume that this is the start of a downtrend, we can perhaps look at this and say that we have a change of behavior here, because here we are seeing more sideways price action. And then maybe we can zoom out and we can say, oh, you know what? This is also a horizontal area. Look at that. We got some sort of horizontal area right here. Maybe this could be accumulation range after a big move to the downside. And then what we see now is a break above that accumulation area right there. The smart money concept traders and institutional investors and everyone's just piling onto euro NCD here, and we've had all the breakout traders. They entered here, they made lots of money, and now the slow break and retest traders, they're waiting for the retest. Okay, what do we see? We see the breakout, and then we see price coming down, hitting that level beautifully right there on the horizontal level as well, on the high of that retest right there. What I would do in this case is put limit orders on either the retest of the breakout level, which could be the last high pre-break of that candle right there, or I would wait for confirmation, which is basically, I think this would be a pretty good confirmation candle. And then when you wait for confirmation, you can have a tighter stop loss. Again, we're going to be talking more about this in system development, but here I would just put probably limit orders right here, and then we could just trail our stops up or take profit up here. Now, what makes a good break and retest? A good break and retest is using the same principles of a breakout with good confirmation. Because when you have a breakout and there's multiple candles closing above the broken level, you're giving the markets enough time to accept that level as broken. So there's a difference between immediate retest and rounded retest. What if you have one big candle closing above here, but you have a fake out, or you have an immediate retest and a small move up? The market is not being given enough time to accept the level as broken, and buyers are quickly selling back into the level and probably continue this downtrend. The more time and space you have between the breakout and the retest, the better that retest will be. Okay. Now, I think this was probably going to be the last thing, but I want to talk about the difference between the first retest, the second retest, and third retest, and so on. Now, imagine that you have a horizontal level right here, and you have an uptrend going like this. You're hitting resistance. So not to confuse people, a fake out and a false breakout is the same thing, but I've chosen to put them in two different categories because fake outs can look differently. And when developing your system and creating nodes on different type of price structures, it's good to differentiate different types of fake outs, because some fake outs might actually be able to trade. So for me, a fake out is just one candle above the next candle below. A false breakout is when you have a breakout and the trend is continuing, but right above the level, the trend is ending. Okay? Because a lot of times a fake out will be the trend coming into resistance, you got fake out, then you have a real breakout and the trend continues. But a false breakout for me is when the trend is actually ending in that level, and the level fails to get reclaimed with good price action. So imagine that you have a resistance level right here, and you have this. So this level consists of 100, let's just say 100 sellers. So you got 100 sellers. With every touch of this level, 20. Now, this is not how the markets work in reality, but it's a good way of giving you a visual of how, why the first retest is important. Now, with every touch, this one, well, let's say 100%. Okay, so 100% sellers up here. With every touch is absorbing 25%. So we got 75%, 50%, 25%. We're now here at 25%. And then on that retest, that number goes down to 0%, which causes a breakout. Okay. Now, all of these 100% sellers, they turn into buyers. Now you have 100% buyers. What happens is when price comes down here, this number determines the strength of this level. Okay. 100% being strongest, 0% being no strength, 0% means broken. This is why the first retest after a breakout is the best retest. That's why you say the first test, best test. So I would like to, I always think in terms of first rounded retest, okay? The first rounded retest. You want to have rounded price action because now you want the market to accept this level as broken. Because imagine if you just have one breakout and then it just immediately, there's immediate retest. That means that maybe it didn't absorb 25%. Maybe it just absorbed 10%. Maybe there's some sellers left here. There's some sellers left ready to sell. They're late into the game, right? But then on that retest, you have enough space and time between the break and the retest. Now, I honestly don't have time to go into the indicators, and I also know that Abe did a beautiful work of looking at the indicators, but this is where technical analysis becomes interesting because now you have a good foundation of the structure of the market with market structure and two of the most basic principles of trading this market structure, which is the breakout or the break and retest. Now, of course, you can be looking at different ways of trading, maybe mean reversal and stuff like that, but that I believe comes later. Now, how do you want to make sure that only the first retest, it's good. It's probably only trading based on this would probably, you would probably be able to be profitable with this, but you want to increase the chances of probability of a bounce. And this is where the indicators comes in, right? This is where you can add something like the Bollinger Bands, and maybe this is the middle line of the Bollinger Bands. Maybe that's the low of the Bollinger Bands. Maybe you have the 20 simple moving average or the 50 exponential moving average moving right here. Maybe you have the 50% fib right here on that retest. And this is where you create what we call, in the world of technical analysis and trading, this is what we call confluence. Okay, and you see that price comes down, it hits the 50% fib, it hits the 20 EMA, it forms a bullish engulfing candle, it forms a low time frame double bottom like Abe talked about, it forms a inverse head and shoulders. Now let me quickly go through one example. Did I just close that? Did I really just close that one that I wanted to look at? I did. I need to show you something here before we go. I think it's quite important. Open load layout bootcamp. Where is it? Head and shoulders. Okay. Why do I want to show you the head and shoulders pattern? Now, interestingly enough, this the head and shoulders pattern is actually getting quite a lot of hate in the world of trading because it's like it's the first candlestick formation. It's the first pattern that everyone learns. Everyone screams, "Oh, it's the head and shoulders. It's the inverse head and shoulders," and it's statistically, this is actually one of the most profitable trading patterns out there. So it's funny. It's one of the most used ones. It's also one of the most profitable ones, but most people using it are not profitable. So do you understand why technical analysis and making money trading doesn't necessarily have to go hand in hand? You can be a great technical analyst and a terrible trader. Merging the two is what creates a profitable trader, which is insanely difficult to do. And one of the reasons I believe why it's difficult is because you're using too many indicators, too much analysis. But what I wanted to show you here with the head and shoulders pattern is this is most likely what it looks like when there's a break of structure without a range. Okay, so what you have here is oh high, all that fun stuff, got another high, comes down here, left, right shoulder, boom, breakdown. This is not a range. This is not a range, but it is a breakup structure. Where is the behavior changing? The behavior changed when that trend line was broken and when this level was broken. This right here is the change of behavior. The change of behavior happened on the cross section of that trend line and the horizontal. The breakup structure happened when this level was broken. It happened right here. Now, let me give you a little secret on how to trade the head and shoulders pattern. And by the way, this level here is called the neckline. What do you think that is? Well, because it's the thing that we have between our left shoulder and the right shoulders. We have the neck, and then there's a line. That's a neckline. Now, even with a double bottom, you're still going to be talking about the neckline. Okay? But there's no head. So why is there a neck? Well, it's just called the neckline, and it comes from the head and shoulders. Now, let me give you a little secret here on the head and shoulders. And I want you, this is not an assignment, okay? So you don't have to do this. You'll do this next week when you're developing your system. What I want you to do, I want you to bring up the fib tool, okay? Go into the fib tool, go into settings, remove everything. It's probably going to look, well, whatever. It's going to look like this. Remove everything. Just remove everything. Everything but, okay? Everything but the 0.618, okay? When you have a change of structure of the trend and you're potentially seeing a head and shoulders forming, I want you to do this. And then I want you to test this. I want you to back test this. And I want you to be surprised by the results. That's where we want to have a bounce. Okay, but we're not getting a bounce. We're getting a change of behavior. We're getting equal lows. You're seeing this and you're like, okay, there's equal lows, possible range, or a shift of structure. It's a possible range or a shift of structure. When you get this, put the fib on from that high to that low. And what do you get? This high equals the 0.618. When price comes up, hits the 0.618, you want to enter on the 0.618. You want to put your stop loss above the head, and you want to put your TP on the neckline of the W. A lot of times, it's going to give you somewhere between 1 to 1.5 R. But if you trade this at a high time frame resistance area, or if you flip it as an inverse head and shoulders and you trade it at a high time frame support area, you're going to have, from my back testing, a decent risk to reward above 50, which means you can take trades that are 1R or higher. And you want to be trading the completion of the head and shoulders, not the break and retest of the head and shoulders, but the actual possible completion. This is the break and retest, okay? And that one is traded a similar way, where you enter on the retest, stops above the right shoulder, and then a lot of times you want to TP that low before entering the head and shoulders. But this right here, this means that you're entering before everyone has already realized that it's an actual head and shoulders. And when everyone has realized that it's a head and shoulders, I believe that the profitability is decreasing. The profitability of head and shoulders is at the completion of the head and shoulders, not after confirmation of the head and shoulders. Okay, so that's what I wanted to leave you with today.